So just kind of keep in mind as a trader, when you have these crazy emotional responses, it's usually wise, as hard as it is, to do the opposite. The more they raise, the more the market, kind of the metrics of the market, the PE ratios have to come in. And at some point, you're going to see this kind of, wealth effect evaporate that we've been experiencing for multiple years with the stock market always making new highs. So when that evaporates, it's going to create a very slow economy, as there's going to be lack of buyers, lack of consumers buying. And I do think the Fed won't be able to fully get the interest rates to where they want without pushing us into a very dramatic recession. So basically this was the breakout. Remember this trend line here sloping down. We got the breakout and then we got a big move up. And essentially the move took us to what you would essentially, as a technician, say was a double top. Double top's notorious resistance points. So you expected gold to pull off here. In fact, I unloaded my long swing trades in gold into this move. Now, what I'm doing is oftentimes after a breakout like this, you'll have what's called a retrace to the scene of the crime, which was the breakout line. So I'm kind of expecting a pullback to maybe 1850 or so. And then right around there, I think that's the big buy for the next big move up. I do think at that point, gold takes out this high here, which was the 2020 high as well. And I think you're off to the races much, much higher. And again, the thesis for this is basically that, there's no way the Fed is going to be able to get fully away from printing money. In the short term, yes, they're stopping, they're going to raise interest rates. But as soon as we get into a scenario where the economy really starts to go into a deep recession, the only way they have really to do it is to stimulate. And the government can stimulate by spending bills, but that's also, inflationary, right? The Federal Reserve can stimulate with quantitative easing, but that's inflationary. So the long term is just so rosy for gold that, again, on pullbacks, you have to be buyers, especially with the breakout that we have seen here recently. And the thesis for the pullback, right? So we've already pulled back from about 2075 back down to about 1940 today on gold, is that I do think that there will be some peace deal worked out in the next week or two. And I think that when you get that, you'll get an initial sell-off in gold. Now, that's just the initial reaction. Just like the pop-up when the invasion started, you're going to see a quick reaction to the downside. And as investors, as myself, I will be looking to buy that. Because once the dust settles, once that invasion, once let's say peace comes back to that area, then people will start saying, okay, now let's focus back on inflation and what the Fed is going to do. And ultimately, again, there's no way to really get long-term inflation back under 2%, in my opinion, without having really, some sort of depression and really flush out. So number one is when things are most fearful, that's when you have to be a buyer. And we've seen it so many times over. A great example of this is that if you bring up the NASDAQ 100, right? So this low on the NASDAQ 100, that was when the markets opened, when the initial invasion took place. So you saw panic and fear. Russia was invading Ukraine, and it actually turned out to be the short-term low on the market. We rallied up. Then we came in, and again, we're rallying to the upside. And so that low is holding at this point. The reason why that's happening is because investors realize that the Federal Reserve may move slower on hiking, which means more money in the system with the invasion going on. So again, in the short term, those type of blips on the screen are usually kind of inverse reactionary things where you go opposite of if it's fear, you buy, if it's greed, you sell. Another great example of this was with the Chinese stocks. Chinese stocks had one of their biggest bounces, if not biggest bounce ever. Alibaba was up like 36% yesterday. Now, if you looked at what it did just prior, it was in a free fall, right? It had already been in a steep downtrend, and it was in free fall because, you heard that maybe China's going to help Russia, then we're going to put sanctions on China. You heard about delisting because of the SEC. You heard about maybe China invading Taiwan. I mean, there was just this confluence of massive panic on these stocks. And again, what does it turn out to be? Well, when it's most fearful, that's the time to buy. So just kind of keep in mind as a trader, when you have these crazy emotional responses, it's usually wise, as hard as it is, to do the opposite. Going to Bitcoin, let's take a look at the chart. So I still am in the same camp that we're going to head lower. I am long a small position in Bitcoin following or with this breakout. So this is a very short-term daily chart. And you can see we just broke above this little wedge pattern here. So I think there could be short-term upside, maybe to 45 to 46,000 over the next week. But once you take that into account and you erase these trend lines, the bigger pattern on Bitcoin is still very bearish. Big move down, and then you have this sideways consolidation. Historically, when you look at this pattern, this big move down with sideways consolidation, number one, it's referred to in technical analysis as a bear flag. Number two, if you look at 1,000 patterns like this, probably about 75% of them broke down lower. Bitcoin won't break out above this level here, but at least based on probabilities, you're looking for at some point, probably in the next 1 to 2 months, a break to the downside and a move down to probably 20,000 or sub 20,000. So unfortunately, as much of a long-term bull I am on Bitcoin, thinking it's worth 500 or $1 million, dollars, 500,000 or $1 million, in the near term, I still think there's got to be a downside move before we get to that point. And you're right, I have been mentioning China stocks, and in all fairness, even after the big rally, I've been talking about them being good buys prior, so it hasn't been the best call at this stage. But again, I do think that the objective of the Chinese stocks is to understand that there's a long-term game plan here. China, just like we saw yesterday, they basically came out and said, hey, we're gonna stimulate our economy, we're gonna basically protect our tech stocks and help them now, and we're gonna make a deal with the SEC. That's a starting point in the right direction. So I do believe that, again, China's not out to crush their golden jewels, right? They're not looking to just kill their great companies. They want them to be big. They just want them to be not monopolistic, so they don't end up controlling the government. The government there is really strict on seeing what's happened in the US with some of these tech stocks being able to control things, and they don't want that to happen. So again, I do believe in the longer term story of China and China stocks. And again, good to see that bounce yesterday. Now, amazing about oil is, and you're right, so once you got the extra kind of event of the invasion, that kind of created this new narrative that oil utilized to really spike to the upside, right? You heard about banning Russian oil. You heard about, the war kind of creating this big move up, and oil did shoot up very quickly to 130 and then kind of came right back into that same 100 area right down here. Now, one of the things to note here, which I think is fascinating, is if you go to your weekly chart, let me see if it's on the weekly, you can see that the high on oil at 130, if you connect that high to the 2008 high and you draw a trend line, these lows are perfectly parallel. So it gave me a good basis. At that point, I started adding to my oil shorts, and ultimately we made some good money when it pulled back sub 100 recently. Now, I do think it's going lower, but before we get into the midterm kind of outlook, I think it's important to recognize that when oil was at 130, so many people were talking about it going to 200. And oil is at 130 or $120 a barrel over the risk of 5 million barrels of Russian oil coming off the market. Number one, that's only 5% of the world's production. So you had price go from 95 to 130, which was a gain of like 33% over the risk of 5% of the oil being taken out of the market. That didn't make sense. Number two, at 120 or $130 a barrel, the demand destruction is massive, where literally I knew people that were saying, hey, I was going to go on this, 3-hour trip to see grandma. Now I'm not, because my tank, it takes me $100+ to just fill up my tank. I'm going to have to do that twice just for this trip, right? So you had this kind of thing where you could argue that just in demand destruction, maybe 5 million barrels globally would be not even needed on the open market. So these were the keys that kind of were telling us that it would come right back in. And so far it has, and I will absolutely look to short it again if it pops back to, let's say, 110. Now, over the longer term, I still think oil goes lower. I think it goes to 75 or lower dollars a barrel. And the idea here is that with the Fed hiking, and we just found out that the UK, their central bank, just hiked. I mean, you're seeing hikes going on all over the globe to try to get inflation under control. With that, you're going to see a global slowdown. I actually look at the chart of oil from 2008 and I say, you know what? This could be a perfect repeat, meaning that oil had this. So the markets in 2008, the markets topped out basically in late 2007, early 2008. Oil still ran up for another 6 months or so. Now, if you look at the stock market this time around, the stock market topped out kind of in November, December. And here we are essentially almost 6 months later again, and oil looks like it's topped out. And then if you look at what oil did in 2008, look at that drop there. The idea is you might have another drop all the way down here. Now, that's kind of the craziest of all scenarios. That would require a massive drop in economic the situation, maybe even a really, really ugly recession. But I do think it is a possibility. I do think that you have to look back at history to kind of see what the probabilities of future moves could be. I think the stock market remains as such. I think, again, if you look at the S&P 500, we've had this awesome kind of bear market rally recently. But, I think the biggest chart that I keep on reminding myself of, and I keep on looking at it daily, is this chart here, where, again, you had this long-term trend, which, by the way, it was when the Federal Reserve was doing some QE. And then you had COVID right here. And then this was your move essentially when crazy amounts of stimulus, way more than this longer term trend, came into the market, right? So essentially I call it the market on steroids, where it was just off to the races. Well, now the Fed has clearly said they're pulling back all those extra measures that they put in during COVID, maybe even additional measures from this period. So in the very least, it makes perfect logical sense that you would at least get back into this longer term trend. And if you see where we are currently, that's still, probably about 10 to 15% lower just to get in the upper range of this. So I still think there's more downside. Be very cautious with the equity markets. Bear market rallies are notoriously really, really massive, but they don't last very long. So we might be seeing this over the last few days. I am looking to sell my longs into this and then likely pick up some shorts on the downside, or looking for that downside.